Monetary Policy Committee evaluated current and evolving macroeconomic conditions and voted today to maintain status quo, while reiterating its commitment to achieving the medium-term target for headline inflation at 4% on a durable basis. If the upside risks we have flagged do not materialize or are mooted in their impact as reflected in incoming data, there is the possibility of space opening up for commensurate policy actions by the MPC.
The Reserve Bank also stands ready to be the lender of last resort, but that is provided conditions warrant that sort of an extreme measure. In our assessment, there is no such necessity at the present.
Well, it is a status quo policy from the central bank, but one with many significant takeaways. The key policy rates were left unchanged in a unanimous decision, but the MPC has handed a sharp cut to inflation forecast and laid down a path to reduce the statutory liquidity ratio, or the SLR, to 18%, with consecutive cuts of 25 basis points every quarter starting January. Governor Patel hinted that there could be some easing in the near future. He said, and I quote, "If the upside risks we have flagged do not materialize or are muted in their impact on the incoming data, there is a possibility of space opening up for commensurate policy actions by the MPC." End of quote. Deputy Governor Viralacharya asserted that measures taken by the Reserve Bank have eased the stress on the NBFC sector. He went on to say, and I quote again, "The RBI is ready to be the lender of last resort, but there is no such necessity at the current moment." End of quote. In another key decision, the RBI has announced that starting April, retail loans will now be linked to an external benchmark and not the current marginal cost of funds, which is known as the MCLR. So, sum and substance, those were the key takeaways of the monetary policy. Let's go across to Latha now for her take on what she makes of it. On the face of it, while it might be a status quo policy, Latha, several significant takeaways.
Well, absolutely. What is the inflation forecast down by? You know, in the din of all this policy stands from neutral to calibrated tightening last time, what we are missing now is what is the extent of the inflation forecast cut? The previous forecast was 3.9 to 4.5. The current forecast is 2.7 to 3.2. So it is a difference of 130 basis points cut in inflation estimate. Likewise, for the next half, that is first half of FY20, the previous forecast was 4.8 and now it is 3.8 to 4.2. So that's also about half a percentage point cut, even more actually, 100 basis if you take the lower end, the lower bound. What the RBI is telling you is that for the next 12 months, inflation will remain below 4%. And policy space opens out even if upside shocks don't materialize. That is, if things go as we have projected, then policy space opens. So what the markets have told you by going into 7.4 on the 10-year is that they are actually expecting a cut. So cut or no, the cost of money for a borrower is what is there in the market, and the market has given you that cut.
Well, the market certainly has given us that cut. Latha, hang in there. I'm going to come back to you as we welcome our guests, former Chief Economic Advisor Arvind Virmani, also with us Surjit Bhalla. Of course, Surjit is an economist and an author, and former Chief Statistician Pranab Sen. Gentlemen, appreciate you joining us here on the show, and Latha, of course, stays on with us. Dr. Virmani, let me come to you first, sir, because you were part of the shadow monetary policy that we had on the channel yesterday. In light of what you've seen from the MPC today, status quo policy when it comes to key rates, but the big cut, that massive cut as far as inflation is concerned, what does that tell you? Space for a change, not just in stance, but also possibly a cut?
So several issues there. One, you will recall yesterday we had said 3 or 4 things which are consistent with what has happened. One is that our shadow monetary policy committee had recommended a lowering of the repo rate by about 25 basis points, and the whole inflation scenario which is being outlined supports that view. I mean, if you take the 3% projection, that means the repo rate is now at 3.5%. that's a huge positive real interest rate, and that has negative implications for the entire economy. The second thing we had said was that there is a need for liquidity measures, and one of the issues which had come up was open market operation, but the SLR was also mentioned. So some action has been taken on that, but I think more needs to be taken, and we are talking about general liquidity, not liquidity specific to particular sectors. And the third point, just to was that to the specific question of what would actually happen, I had said that 50-50 chance of of moving to a not moving the stance and moving to a neutral stance. So the last point which the governor made about if the upside risk doesn't materialize could be seen as a kind of move to neutral, so that 50-50 has also kind of come true.
All right, so you seem to have aligned yourself to what we've heard from the RBI governor today and the MPC. But Surjit Bhalla, I would imagine that you're patting yourself on the back, especially when it comes to inflation. Your big grasp with the Reserve Bank has always been that they've gotten it horribly wrong as far as inflation is concerned. Given the sharp cut that we've seen on inflation, does this now give you some sense that you're on the same page, or they're on the same page as you are?
No, it gives me a lot of comfort that they're on the same page as reality, and I happen to have been there at least for the last 2-3 years. But what is intriguing about this, and your channel, everybody, is that this is a pause. Then the other thing I've heard that we are still sticking to calibrated tightening, and that the inflation forecast has been cut by 1 percentage point, sorry, and that, as Arvind just pointed out, that implies a real rate of something like 3.5. Now, can you please tell me as to what sense does it make for anybody, let alone the RBI, to say that we are in a calibrated tightening phase and we are having the highest policy rates in the world, the highest real policy rates in the world. So I think there's a real disconnect there. As you know, that in the program yesterday, I had said that maybe in terms of forecasting what the RBI might do, that they might have their ego come in their way of making sound economic policy. And that's exactly what it seems to have happened. But if you go ahead and forecast
let me come in there. Let me come in there. Let me come in there on the issue of ego, for instance, and just to take on what we've heard from the Reserve Bank of India, the governor very categorically they're stating that, look, we've seen a significant amount of volatility. The last time we did the policy, the rupee was edging at 75 to the dollar. Crude prices were 80 plus. Today, it's a completely different picture, and so we need to see if the data is durable enough. If it is, and it's commensurate with what we've forecast as far as inflation is concerned, it perhaps leaves the space open for monetary policy action. Okay,
let me answer that. Very good point. And the oil prices have been volatile, but the food prices have consistently, and overall inflation, excluding oil, has been very well behaved, and they haven't yet excluded oil from there. So if they say, let us say, what has happened? We have had oil prices at 85, right, just a month ago. And what was the overall CPI? Less than 4%. So I don't understand. So either it is a very limited core, which is what the RBI is targeting, then they should come out right and say it, that we are targeting our version of core, which includes petrol, which incidentally there's no other central bank in the world which has its core CPI including petrol. So they have to come out and be clear as to what their targets are. So volatility absolutely has been there. Why did they lower their forecast? They also know that there's volatility in oil of an extraordinary amount. I fully agree. Then why did they cut the inflation forecast by 100 basis points? Is that consistent?
You know, let me just bring...
They should have said...
Let me bring Latha back in, because Latha, you know, I think... Okay, let me bring Latha back in on the oil point that you're making and the volatility that we've seen, because Latha, I remember Pradeep Pandya asked the governor the question on what's the assumption on oil that they've made. So there was a clarification that came in there from the governor on that front.
Yeah, he pointed out that volatility of oil futures is, even higher than the volatility of stock futures at this juncture, which means the oil market is also pricing in the possibility of crude going higher, which is why they don't want to take a durable step. That seemed to be the underlying explanation, that if we can see that volatility go down, they would be in a bigger comfort zone to be able to go ahead and give that cut, not his words. I'm interpreting him to say that. But clearly, because, if things can go 30% down in 8 weeks, the chances of it going up maybe 10 or 20% in the next 8 weeks cannot be entirely ruled out. And that is what the oil futures volatility index is telling you. That was the point he was making.
Mr. Bhalla, a quick response to that before I go back to Mr. Virmani?
No. I'm making a very simple point. Assume for a moment that oil prices go back up to 85. What did we have as inflation when oil prices were at 85? Less than 4%. Their durable inflation target, headline inflation, is 4%. Therefore, I ask, what does the oil price have to do with it? With their policy.
Okay. All right, let me bring... let me bring Dr. Virmani back in and discuss the other decisions that were taken. The decision on SLR, which was part of the discussion that you had, and also on CRR, which has been discussed and debated, but the governor pointed out that it doesn't come under the ambit of the MPC, and he doesn't believe that it's the instrument to manage liquidity, at least at this point in time. What do you make of both those decisions?
So let me start with the CRR. My understanding is that the RBI Act has been changed, that CRR cannot be reduced below 3%. And so I think it's correct. If the CRR value is supposed to be a liquidity measure for the banks, either that liquidity is not needed and you should not have a CRR. That's a structural decision which cannot be part of the monetary policy decision. I mean, we may agree or disagree with that CRR number, but I don't think that is part of the monetary policy decision. So that's as far as the CRR is concerned. Now, as far as SLR is concerned, we've been thinking about this like not just for a decade, maybe 2 decades, of how to bring that down and give the banks more flexibility. And certainly any measure, I mean, these things have to be phased properly, they have to be timed. So I certainly welcome the announcement of a schedule. Perhaps, it could be said that it should have been done faster, but that applies even to previous RBI governors, etc. So I will go with that. I think it's a good move. We must over time bring down this SLR.
Okay.
And there's been kind of widespread consensus on that.
Okay, so thumbs up coming in there from Dr. Virmani. Latha, coming back to you now as far as what the commentary was as far as liquidity measures are concerned, and the Deputy Governor Viral Acharya talking about the OMOs, talking about how the quantum of OMOs going forward will depend on forex operations, sterilization, etc. You've been speaking with a whole host of market voices, Latha. What's the sense that you get from the street on liquidity and what this could mean going forward?
Well, I think the comfort on liquidity was welcomed with open hands. The market did not expect such a proactive statement. The Deputy Governor's statement was that the momentum, the pace and the quantum of open market operations shall be increased. And the least that you can read from that is that there is a 40,000 crore of open market bond purchases happening in all the 3 months of the first quarter, Jan, Feb and March, which means the Reserve Bank would actually at the end of March have bought 3 trillion of bonds, and that is, it would have pumped that much amount of money. And that was one reason why not only did the bond yields fall to 7.45, the expectation is that we're going to see a 7th quarter very soon, which is what I meant by saying that one cut has already come in the market, and another cut is hiding because of this, ours to take because of the open market purchase operations quantum announcement. But the second and the more important thing that Viral Acharya said is almost a Draghi moment, saying that they will do whatever it takes to restore normalcy in the NBFC sector. His point is that we stand ready to be lender of the last, offer lender of the last resort services, provided conditions warrant such an extreme measure. But according to us, there is no such necessity at the current moment. I spoke to about half a dozen fixed income fund managers after that, and the near unanimous view is that that's an extremely comforting factor. Already we have seen the CP yields of not just non-NBFC, not just manufacturing companies, but even NBFC paper fall by a bit. And just to hit the nail on the head, the HDFC bond that was floated last week at 9% is now trading at 8.75. So, you know, this sheer proactive promise has had a salutary impact on the cost of money, even for NBFC, I mean HDFC, the Arch Housing Finance Company.
Okay, Dr. Bhalla, would you say, as Latha was pointing out, that this provides the salutary impact that the market was looking for, the government has been hoping for? Does this now adequately address the issue when it comes to NBFCs and the liquidity situation that we've been talking about for the last several weeks now?
Yeah, I think the promise by Viral Acharya to do whatever it takes does, I think, bring a lot of comfort and satisfy most people, including myself, that this very important issue is finally being addressed by the RBI.
Dr. Virmani, a quick word from you on that, and then I'll talk about another contentious issue which the government has sort of, again, been sort of pushing back to the RBI about, which is the SME sector. Now, this was taken up at the last board meeting of the Reserve Bank of India, but it was interesting today that they talked about the need for a comprehensive review of the SME sector, to come up with a comprehensive solution package for the SME sector. But they've said that the RBI will set up a committee, and that committee will be set up by the end of December, and it will give its report in January. So does that suggest to you that there perhaps is no further appetite from the Reserve Bank to do anything more to address that sector in specific at this point?
So very quickly, you know, I have been making this point on the advisory committee when Raghu was here, that India, the markets are not perfect. So the RBI has to focus on both the repo rate as a signal, plus the actual liquidity in the economy. So I'm glad, you know, and yesterday when we discussed, our committee had said that there is a problem of liquidity, general liquidity, and this must be addressed. So again, as Latha has explained, you know, I hadn't followed all the details earlier, but clearly the RBI has taken that on board and is doing something about it. So I would welcome that also. Now, moving to your question on MSME, you know, my impression was that with the coming in of GST and the filling up of, if I may call it that, of the supply chain of MSEs into the organized system, or coming above the table, if you want to call it, or becoming more transparent, there would be better credit from the banking system. But maybe there are hindrances, etc. So certainly, you know, having a committee to make sure that the advantage of bringing in a lot of companies into the GST, and therefore, you know, making them white in a sense, where their cash flows become transparent, should facilitate much greater credit to these MSMEs. So hopefully this committee will look at those kind of issues and remove any problems, little hindrances, rules, etc., which are there.
Latha, the governor did not comment on any of the questions that asked them about the issues with the government, Section 7, or the next board meeting, etc. Said he will not comment on any of those issues. There's been no reaction from North Block on the MPC so far either. But given the spate of issues that were on the table, the last board meeting, and as we now move closer to the next one, what's your own sense in light of what we saw from both Urjit Patel as well as Viralacharya today?
Well, I think in a sense an olive branch, because the liquidity issue has been comprehensively addressed by being proactive that both the quantum and the pace of open market purchases will be increased. If the necessity arises, a lender of the last resort line of credit to NBFCs as well. And, the announcement of practically a near neutral policy. I mean, this policy is all but neutral. They've gone back from calibrated to neutral without saying as much. That will perhaps have met what the board wanted halfway. On SME, maybe there will be still some ask by the government that this should be advanced and that a committee at the end of December, maybe next month, maybe a little too late. Maybe, to some extent, I think the battle lines have been blunted with, I think, the Reserve Bank being somewhat proactive, or you can call it checkmated, what the board wanted.
Okay, let me get a quick final word in from each of our guests. Dr. Bhalla, I'll start by asking you, what would your headline be at the end of this MPC?
Welcome to reality. One other thing that has happened, and while we were talking about oil prices and volatile and therefore not cutting rates, I'm sure the RBI and the MPC have noted the fact that for the first time in, 8-9 years, the US credit markets, actual bond markets, are signaling a recession 6 months hence. So they're also watching oil prices, I'm sure. So to use the oil price as a bogey for, or as an excuse for not addressing one half of the monetary policy question, they have very adequately addressed and are promising to address the liquidity part, the quantity part, but the price part, I'm afraid, they haven't. And so that leaves a little bit off the table from what could have been a comprehensively new MPC.
All right, welcome to reality. That's the headline from Surjit Bhalla. Arvind Virmani, what's your headline?
Yeah. So I would say that, that the distinction must be made, and I think it will be increasingly recognized that it's the monetary policy and inflation control which MPC, headed by the RBI governor, has complete autonomy, and they are doing what they think is best, as indicated by the 5-1 vote on the MPC, which we have been given. So whatever it is, right or wrong, which we discuss separately, they do have autonomy on that issue. Where the disputes have been is on two areas. One is financial stability and the liquidity issues connected with it, and second is the regulatory issues, where the existence of the public sector banks creates a little bit of a problem. But we haven't discussed that last issue, but let's leave it at that.
All right, gentlemen, we'll have to leave it there. Arvind Virmani, Surjit Bhalla and Latha, many thanks for joining us to discuss the highlights of the Monetary Policy Committee and what it means for liquidity, for the bond markets, for the equity markets going forward. We'll take a break. There's a lot more coming up. Don't go anywhere. Stay tuned to CNBC TV 18.